Lenders are now responding to growing competition from mobile phone-based lending services. 5 Kenyan banks have launched a lending service via mobile phone. It is aimed at getting credit through to the country's small and medium-sized businesses. Now, under the new pilot service, KCB Bank, Commercial Bank of Africa, Cooperative Bank of Kenya, Diamond Trust Bank and NIC Group will be targeting about 3,500 businesses. Well, let's discuss this new development and of course how it will impact the lending industry in Kenya with Billy Owino. He is the CEO of TransUnion Kenya. Very welcome to the show, Mr. Owino.
Thank you for having me.
Let's start off with the entrance of these 5 banks. How do you think that will change borrowing trends in the country going forward?
Actually, I think it's a very exciting development for us because if you look at the SMEs, especially in the onset of the interest rate caps, they've really been starved of credit because banks stopped lending to them, or this was really cut down quite massively. I think over the years, the last 2 years, growth of credit to the SMEs has been growing at about 2%, which is very, very small. However, when you look at most of the SMEs, they require not so much in terms of funding. It's anywhere from 5,000 shillings, 50,000 shillings, all the way to like something like 200,000 shillings.
Right.
And this initiative comes to fill in that gap because one of the reasons why the SMEs are thought to be risky is because there's a lot of lack of data on them. Right. So when we go on the mobile, though, however, we can start collecting a lot of data on these SMEs because let's not forget that most of the SMEs are run by individuals. So there's a lot of data you can get from the owner of that company, plus together with how the company is doing, the cash flows on the mobile because they transact on mobile, and build that and use the data that's available to start providing credit risk and credit to these SMEs. So it's a very exciting development for us in this market.
Yeah, and as you mentioned, it will certainly increase the need for better infrastructure, better data collection in the industry, better credit scoring as well. Now, banks, a common claim we hear from the banking side is that they have limited data which they can use to make preferential lending decisions. Is there any merit to that argument?
I think it depends on who you're looking at. So, for example, if I'm a customer of the bank today, and I've been transacting and borrowing, that data is there. It's available, However, if a bank is looking at maybe a customer of theirs who's never taken credit, for example, so there's very little that they can assess that customer with. However, out there's a lot of data maybe on that same person. So that data is available that the bank can leverage to be able to start lending to that consumer. And then you have that consumer who's new to credit, has never taken any form of credit. So you can never really assess them. Those are the ones that you can say we've got very little data on them. And they can be the ones that are difficult to assess for credit. However, the landscape has changed quite a bit in terms of depth of data. So today at TransUnion, we've got a profile of 19 million consumers, out of which 11 million are credit active. So which is quite a big amount of data we have. And this has quadrupled over the last 4 years. So data is now there. Leverage, if combined with the data that the banks have, we have enough to provide credit scores and do risk-based pricing to the banks.
Give us a sense of how this will be done in the Kenya or East African context going forward.
The fundamentals are there. So since 2012, we've had information sharing, both positive and negative, and that really forms the framework that we need. Because remember, for you to be able to do risk-based pricing, implement scores, you need the scores, and that depends on the data. So we've had this data shared by the regulated institutions since 2012. And then 2015, we launched our credit scores as TransUnion. We were first in the market when it comes to that. So we've actually had credit scores since 2015. So the right data is there, the right framework is there. Credit information sharing is happening across all the 3 bureaus. We have 189 lenders today who share data with us. Consumers are becoming more aware of what their credit scores really mean. So I think we have everything in place to really go that way. We've had 4 years of very good data on consumers. So I think what is next now is just for the lenders to start implementing this, adopting credit scores in their lending decisions, out of which, most of the banks, especially the tier ones, have already started doing that. But I think it's work in progress as we go down the tiers.
Right. Yeah. Now, taking us back a little bit, we know the banking charter, which went into effect at the end of the first quarter, it actually compelled banks to make lending and pricing decisions with clients' credit scores in mind. Did this make any difference in the market back then? And how do you think they're going to proceed in that area going forward?
We've just started the journey. However, I'm very positive in terms of the response by the banks. I think what needed to be addressed first was the challenges we've had in terms of consumers getting to really understand, what is a credit score? What does it mean to me? And then on the other side, the lenders also being able to understand that there's enough credit scores, there's enough data for them to be able to make data-driven decisions, yeah? Because that wasn't happening on the side of the financial institutions, yeah? So we, and the central bank has been very good at driving that initiative with the help of Treasury, CIS Kenya, which is the Association of Credit Institutions in the country, and of course Kenya Bankers Association. And it was more around, let's look at the whole thing, yeah? Let's unpack it. What's the problem? Is it an understanding on the bank side? Is it an understanding on the consumer side? So right. That's been tackled now. How is the data? What's the quality of the data? So there's been an initiative the last 6 months to just look at, how is the quality of the data? And that has gone very, very well. Everyone is happy with the quality of the data that we have. So we are very well positioned. So the drive by the central bank to really push for risk-based pricing is very timely. Yeah? And it's also timely because that's the only way consumers are going to get the benefit of maintaining good credit scores, for example. Yeah? Because, I say a credit score is like a financial CV. Yeah? So what's the point of maintaining a good CV if it doesn't really mean anything to me? So it's time for consumers now to start getting benefits of maintaining a good credit score. And this is in terms of them being able to get, better facilities, yeah? Better interest rates when they're being priced for loans. Or, if a bank was going to ask me for security when they're lending to me, maybe by looking at the data on me, they might realize with my score, they don't need to ask me for security. And this cuts across, both for individuals and even SMEs today who are starved of cash. Yeah.
Well, give me a sense of how far you think we are from operating in that environment where, like you said, your credit score is sort of like your social security number. How far do you think Kenya is from that?
We're actually very close to getting there.
Right.
If you look at the developed countries, all the fundamentals are in place. I think the deliberate decision that the central bank made to put in the banking charter was really, really necessary to kind of like put it in place. So, it's already happening. Today, if you look at some of the banks, they're actually pricing you based on what your score is. Yeah. Really? So it's happening, and this is across the board for traditional loans. If you're going for a personal loan, vehicle asset finance, or even a mobile loan. Yeah. So those who purely take mobile loans, especially from the banks, they'll notice that, for example, their limits keep on changing, and that if you look at it and you look at your score, it's correlated to how your score is performing. So it's happening today already.
Well, how do you think that's going to affect rates going forward? Because isn't it impossible for banks to lend to retail clients at the same rate that the state is borrowing from those same institutions?
Yeah, I think a couple of things need to happen. One, we definitely need to relook at the whole interest rate caps because despite the fact that we have everything in place to start pricing when it comes to risk-based pricing, right. As long as we have the caps, it might still not be really possible for the banks to implement that very well, the lenders, and then we won't have the real benefits out to the consumers. Yeah, so I think we need to relook at that, make it open, and I think the chairman of KBA, who's the CEO of commercial KCB, Mr. Igara, has been very specific about that. He said, even with the repeal of the interest rate caps, they are not going to go haywire and start lending with crazy interest rates. No, they're going to adopt your score. They're going to really look at how your risk profile is and get it going. So those two things need to happen. We need to relook at the interest rate caps, get it out of the way and leave it open for them. But I think the lenders have already signed up to that charter which really is going to ensure that consumers get the benefit of their scores.
Well, thank you so much for joining us and for your great insights into this discussion. Of course, that was Billy Owino. He is the CEO at TransUnion Kenya.